me, type in the question box how happy you are that tax season is over. Are you happy? Are you really happy? Kind of happy? Are you celebrating? I have some woohoos. Yay, very, very happy. Woohoo. Do the dance. Yay, ready for tomorrow off. Ecstatic. Oh, yay, you guys are celebrating there. Nope, in Canada it's not over yet. That's right. You guys goes through April 30th. So you Canadians, hang in there a couple more weeks. You're almost there. Jean says 35 years and counting. Majority done. Still got some last minutes. Wow, everybody's excited now. All right, well, very good. So you guys can all hear me. I'm going to go ahead and start the recording, and then we will start the broadcast in just 10 seconds. So hold on 1 second. Welcome, everybody. Thank you for joining me and Hector Garcia for another QB Power Hour. Today we're going to be talking about customizing QuickBooks reports for attractive presentation. We're going to go through some of the preliminary stuff kind of quickly because you guys have heard this all before. So we're going to be talking about QB Power Hour. We're going to introduce ourselves, CPE process. We'll have a couple of announcements. And then I'm going to talk a little bit about using the management reports in QuickBooks Online. Hector's going to start off with talking about some of the insights because he's an ex-banker. He's a former banker. Give us some insights into how lenders look at the small business financial statements so that we can kind of understand what kind of reports and things that they're needing. We also have a special guest with us today. Meredith from Fundera is going to discuss the SBA loans and some popular alternatives to bank loans. This is an area where we can really help add value for our clients. We're providing them financials already, so understanding some of the information the banks are looking for and the reports and things like that is a great way for us to add value to our clients. My name is Michelle Wong. I am a CPA with my own practice for many years now, as well as a speaker and an author. I'd invite you to join us in the LinkedIn group. Those URLs are there. Hector, you want to go ahead and say hi real quick?
Hi, everybody. Happy Tax Freedom Day. And happy to be here, and this is going to be a fun one.
Very good. All right. Yeah, Hector's going to tell us a lot more here in just a minute. So again, the QB Power Hour is every 2 weeks. Thank you for joining us today as you're recuperating from tax season. Hope you'll join us next week too. So let's go ahead and talk real quickly. Are the primary sponsors of QB Power Hour are Hector and myself, our companies. We also have some other vetted sponsors occasionally who are going to join us and share some great information, just like Meredith from Fundera today. We are not officially sponsored or associated with Intuit, although we do have a close relationship with Intuit and like to have them on as guests periodically throughout the year. The CPE, again, you have to attend for at least 50 minutes, so you need to be logged into this webinar for 50 minutes. Pay attention for that CPE password that we will give you during the webinar today. Then at another time later in the webinar, you're going to get a poll question where you need to answer the question with that CPE keyword. So when you hear the CPE keyword, write it down and then answer the poll question with it later, and then give us about 3 weeks to get those certificates to you. Couple of upcoming events. Love to have you join me and Sandy Smith-Leva for the award-winning Ultimate Accounting VCon coming up in May. 2-day virtual conference with lots of great information. Also, Hector and I both will be at Scaling New Heights. We'd love to see you there. QuickBooks Connect coming up in November, as well as SleaterCon in November. All great conferences so you can continue learning and expanding your knowledge and skill set. Hector, you want to go ahead and get us started today? You want to go ahead and start talking to us about what banks are looking for?
Can you guys hear me?
I can hear you just fine, and I'm going to change the presenter to you and let you, I'll let you because there's 2 of them on there, so you, I'm not sure which one.
That's fine.
Hopefully that one's the right one.
Yeah, that was it.
All right.
So the premise is that I have a lot of clients that come to me and say, Hector, my banker, my bank, it's asking me for financial statements. It's asking me for reports. I'm applying for a loan. Can you help me? They typically really rely on us to provide these things. And my clients have been properly coached that if they're going to apply for a loan, not to print random financial statements from the QuickBooks because, first of all, they could be messy. We don't know if things are reconciled. How about things classified in the wrong place? you could totally, throw off your banker by not having that. So I believe there's a lot of value on having the clients involve us, the consultants, in these type of things. So I'm going to ask you a quick polling question to just kind of have an idea of, whether or not you do perform these services for your clients. So do you have clients that ask you, hey, can you help me get some financial statements for my bank, and are you involved with that? It will be interesting to know whether you don't want to at all, or it will be something that you do want to get involved with, or you already get involved with. Okay. Now, what happens is a little bit of a disclaimer here. What happens is if you're a CPA and your client asks you to prepare financial statements, you may have to get into a whole engagement, right? You have to first of all get paid for your work, for your time. You may have to perform a quick review of the financial statements. You may have to apply certain special accounting rules. You may have to disclaim certain items. So it's not that simple if you're a CPA to just jump in and produce those financial statements. Okay, so I'm going to share the results with you real quick to see kind of what the answers were. And there it is. Okay, so let's start with what do banks typically ask for and go through the reasons why. So typically banks ask for 2 to 3 years of tax returns. They typically ask for personal and business, even though it's a business loan. And the reason for that is because they know that the small business owners have a lot of control over the business itself. So they like to see if there's potential issues with income or with losses on the personal side to make sure that the corporation stuff that can potentially affect the personal and vice versa. And then they ask for interim financial statements. So they always ask for the QuickBooks financial statements in the middle of the year. And we're gonna focus on that. So we're gonna take you through a whole flight of that. I used to be a banker, and I used to request these things for a living. I really didn't understand why until a couple of years in, where I really started understanding how the banks think, how underwriters think, what are some of the information from these reports that are useful to the banks, what is not. So I'm going to take you to that entire flight. So the optional reports, typically banks don't ask. Well, it depends, but not always they ask for AR aging, AP aging. Not always they ask for inventory valuation, cash flows, budgets. But if they're well presented, I recommend you add them, because everything that you add to those financial statements helps out. Okay, let's go to the next slide here. And so what do typical accountants or bookkeepers do when the client says, hey, help me send my bank some financial statements? So they'll go into QuickBooks, they'll print the P&L, print the balance sheet, PDF it, email it. It takes them less than 5 minutes. The typical accountant or bookkeeper is involved in that request, but it's not really there to kind of help your client. So what a skilled business consultant would do, and again, I have to make the CPA disclaimer, it would apply something that I call the art of preparing attractive reports, which is what I'm going to cover in the next 10, 15 minutes or so. And it does take a couple of hours to do right, and it's always billable. Again, your client is always going to pay an accountant or consultant that is helping them get access to that capital. If they're asking for a loan, if they're requesting a loan, it's because they have an opportunity to grow their business, and getting, increasing the chances, you can't guarantee it, but increasing the chances of getting approved with attractive financial reports is definitely a huge, huge value. So I made the CPA disclaimer. Some of the techniques that I'm going to show you, they could use GAAP concepts, but for the most part, because we're sort of modifying the presentation, this may hinder your independence. So if you're engaged with the client to do audits, reviews, anything with attestation, you would lose it by getting involved with the client and doing the things that I'm about to walk you through. So first of all, let's talk about the choices that we have to make. So the bank will ask for a P&L and a balance sheet. That sounds like a simple request. But we have to make a choice. Are we going to send them collapse, expanded, or are we going to select what we're going to collapse? Are we going to send month by month? Are we going to send quarter by quarter? Is there any value to doing it by class or by job? Last month with a year-to-date previews. So I kind of want to cover those real quick. I'm going to jump into QuickBooks Desktop here. Let me Give me 1 second so I can show you that example. And it should be up and running now. There it is. Okay. So when they ask for a profit and loss, right? So typically we would take in a profit and loss for the middle of the period, year to date. It's very common. I would say one of the most common things is that we actually stop at the previous month. That's one of the single most common things is we send year to dates, but they're not really year to dates. They stop up to the previous month because the last day of the previous month typically is the last day that has been reconciled. The other choice we have is, do we send it expanded, right, where it shows all the sub-accounts, or do we send it collapsed? And my take on that is I would only show it expanded if the breakdown adds value to the presentation. If it adds fuzziness or if it makes the report bigger than 1 page, I typically would recommend not to do it expanded. The other questions is, should we send monthly, right? So should we do something like this and send a monthly report? So my take on this is, since the bank is not asking for a monthly, if you have a very stable revenue stream, right, where every month, like in this case, it looks like it's stable, for the most part it's stable, but every month is stable, then month by month works because banks like stable income. If it's all over the place, like 1 month is 100,000, the other month is 20,000, or like in this particular case, let me make this a little bit bigger. In this particular case, we're going from 84,000 down to 65, up to 114 down to 60,000. In this particular case, I would be careful with showing a quarterly report. Again, the premise is we're not changing the numbers, we're changing the presentation. I want to make sure that's very clear here because we're still independent accountants doing an independent accountant's job. But what I'm saying is, if the quarterly report or the monthly report helps the deal, right, because it shows growth or stability, then you show it. If it shows instability, high seasonality, all of income and expenses all over the place, then I would probably avoid doing that. The other common technique that we do is show a year to date, and then right next to it, show a previous year, right? So what I would normally say, like in this particular case, there isn't anything on this QuickBooks file, but if the previous year shows in comparative to this year, an increase in sales, a decrease in expenses, an increase in margin, then show it comparative. If it doesn't, don't show it comparative. Don't add any more reasons for the bank to look for a decline. So there's a couple of tips I wanted to show you on that real quick. Okay, so back to the PowerPoint, and I'm going to turn off the webcam here because we're getting some speed issues. Back to the PowerPoint. So let's talk about the organization of the report, right? Cost of goods sold, expenses, other income and expenses, account numbers, sorting by value, and marketing and selling versus general and administrative. So let me show you a slide that I put together on this. And the slides are available for download, so I recommend you have these. These are very useful to work with your client with. Is cost of goods sold, you want to reserve direct expenses, typically variable, so things that change as income changes. Expenses you can associate with a customer or a job, and they're typically predictable. They're predictable because gross profit is a fixed percentage. So when you have a lot of sales, your gross profit margin stays, but your gross profit amount grows and shrinks with it. Now, the operating expense are used to calculate net profit. They're typically indirect. I say typically fixed. So, for example, telephone expense is considered to be a fixed expense. But a lot of people say, well, 1 month my cell phone bill is $200, the other month is $300. That's not fixed. Well, yeah, it may not be the same exact amount, but from an accounting perspective, that's a fixed expense. It's typically fixed. Typically, they're unallocated. There isn't anything. You should not have any expenses allocated to jobs. If you have anything allocated to a job, it should be a cost of goods sold. And it's semi-predictable. The reason why the fixed operating expenses aspect of it are not as predictable is because there's a lot of management discretion. There's management judgment, right? The management decides whether you should have a 3,000 square foot office or a 500 square foot office. Management decides if you're going to have, top of the line computers or simple, cheap, inexpensive computers. So that's what I mean by manager's discretion. And then make sure that you move everything out of expenses and income that is extraordinary, that is non-operation. This is one of the biggest mistakes people make. They put interest income in the top revenue part. They put interest expense in the middle of the operating expenses. Depreciation, amortization, income tax, capital gains and losses, extraordinary items. Separate them from your fixed expenses because they really provide a lot of value when you're displaying the reports. Okay. The other quick piece here, I know most of you know this, is the account numbering system. Make sure you follow an account numbering system that a lot of people will understand. One of the big areas where people get a little bit confused is, whether we should have two numbers for expenses. And my answer is yes. If you can separate general and administrative as one bulk of expenses and selling and marketing as another bulk of expenses, I would separate them into 6,000 and 7,000 accounts. And I'm going to show you a specific example with that and show you how great it is to do something like this. So how would you split general, administrative, and sales and marketing? So typically, operating expenses like rent, payroll, overhead, staff that is not directly related to sales, that would be under G&A. These are the most typically fixed, right? These are fixed expenses, and they're very typically indirect. And these are predictable based on budgets, right? Because we set up budgets for G&A expenses. Now, for selling and marketing, these are advertising. These are incentives to sale, bonuses, anything that could be directly associated with selling, right? Not with the sale, but with the act of selling. So if it's directly associated with the sale or the customer, that's cost of goods sold. But if it's related to selling activity, then it would be under this category here. Your sales payroll will be here, your sales staff payroll, and this is typically variable. This would actually have a more direct relationship with, not with sales, but with the growth of sales. So typically an increase in selling and marketing expense should render an increase in sales, right? It doesn't go the other way, where an increase in sales directly creates cost of goods sold. This is different. This would be more of a cost effect, right? So if I invest into this area, I should see sales in the future. And these are harder to predict because obviously the manager has more discretionary use. Onto the balance sheet, some of the things that are very important to keep separate is, spend good time identifying fixed assets. I can't stress that enough. So many people put fixed assets under expenses, office supplies, and they put it on the profit and loss. And what ends up happening, the big issue is, what ends up happening is that you expense everything and you have no way to present the tools that your business has available to produce. That's one of the huge problem, right? So the tools are available for you to produce, to make money, your infrastructure, that should be in your fixed asset report. So what's the typical threshold that we use? The most typical that I've seen is 500. Obviously, it has to get depreciated, and typically the tax guy takes care of that. Now, under other assets, people get a little bit confused about what goes in there. Other assets is going to be for franchise fee, for goodwill, security deposits that you're going to get back in less than a year. So typically, if you have a security deposit that's only for a year, which is not common, right? Because you try not to rent for a year, but the rent contract is a year, but you want to stay there for longer. So because of that, we put that in security deposits, long-term receivables, investments, things like that. Now, under current assets, the concept is anything that is cash or convertible to cash within an operating cycle, which is typically a year, that would be considered a current asset. And I have them organized in terms of liquidity, and liquidity is a big deal for banks and for lenders. Liquidity means, if I go after the assets of this business, how quickly can I get repaid? Through, for example, cash, obviously that's quick. Financial investments, that's like securities and investment in the stock market. Receivables, inventory. So basically, the closer you are to the top, the easier it is for the bank to recover if your assets are being collateralized. Now, current liabilities, same sort of concept. If it's a claim against your cash and is payable within an operating cycle, which is typically a year, things like credit card, lines of credit, make sure you don't put lines of credit under long-term liabilities. Put lines of credit under current liabilities. Loans payable within 1 year. So for long-term, anything that's payable. Oops, there's a mistake on that one. But this is just basically payable after a year. So payable after 1 year, right? Sorry about that. And then under equity, one thing that I strongly recommend, especially with partnerships and with retained earnings, at the end of each year, grab that tax return and roll over your retained earnings to each of the partners' capital accounts. That really helps the presentation know, where your capital is, which of the owners has claim into that. And the single most important tip I can give you is when the shareholder lends money to the business and you put it under liabilities versus putting it on additional paid-in capital, it creates a problem with your net worth, right? Because if the owner puts money in the business and does not have a loan attached to it or a loan contract, loan terms attached to it, there should be no reason why that capital is going to be under a liability or long-term, short-term. So it really helps with presentation having the shareholder loans as additional paid-in capital instead of that. Okay, Michelle, I'll take a quick break real quick. Are there any questions that you want me to cover, or should I keep going? What do you think?
No, I think go ahead. I've been answering the questions as we go along.
Okay, perfect. Now, AP/AR reports. So one of the most important thing I'll tell you about AP/AR reports, and let me pull up here in QuickBooks an account receivable report, and I want to give you some context in terms of if a bank looks at something like this, why would they do this, right? Let me open up another QuickBooks file, one that has possibly more receivables to kind of show you. So if a bank asks you for a receivables report, you have to understand what they're going to look at. So these are the things they're going to look at. One, who are your customers, right? Now, are your customers reputable, established businesses, right? Is there a high probability that you will get paid from these customers, or are these companies that are known to be in bankruptcy or something like that? Whoops, I keep opening a QuickBooks file. Let me open a sample file. What else are they going to look at? They're going to look at aging, right? If you have a lot of receivables that are, in this case, if you have a lot of receivables that are under 90-day plus or the 60-day plus, the probability of collection goes much smaller. It's like when your cousin, asks you to borrow $100 and you give it to them, and then they ignore you for a whole year, thinking that the longer it takes, the closer the probability is that you'll forget that they owe you the money and you're going to collect. It's sort of the same concept, right? So the older the receivables are, the less of the probability of collection. The problem with that is when banks see that you have a lot of receivables, which normally from a faraway view looks like a positive thing because it's an increase in assets, it may be very negative if the bank has reason to believe that these receivables are not collectible. So what you want to make sure, and let me go back and take a look at this. So you want to make sure when you're displaying financial statements, this account receivable aging reports, you want to make sure that the due date on these invoices are correct. So one very typical mistake that people make is that there's an invoice in QuickBooks and the due date is hidden or it's not even shown, and they have the wrong due date. So what ends up happening is, if the due date in this case is correct, so let's say this is 10/30/2018, right? And today is December 15th. If that due date is correct, then it's going to move along in the AR report. So what used to be in a current status is now 31 to 60-day status. Same concept with old invoices. It is possible that, and I'll show you an example. So it is possible that I have an old invoice, let's say from 6 months ago, right? I have an old invoice from 6 months ago, and I'm going to put here due on receipt, and I'm going to pull up my AR aging report, and we're going to see exactly what that looks like. So I have an invoice from 6 months ago. It looks like it's 90-day plus. Now, what if this is not 90-day plus? What if the terms was, yes, we did the work 6 months ago, but our agreement is that you were going to pay 4 months later? Well, that changes the dynamic of everything. Aging is not about the specific age of the invoice, is the age of the due date. It is so important to keep that in mind. Aging is the age of the due date. So if your terms said that this invoice was due November 30th, even though it's from back in June, if this were my original terms, this is part of the contract, whatever the circumstance may be, when I go back and look at my AR-18 report, it doesn't look 90-day plus anymore. It looks correctly where it's supposed to be. The other thing that banks look in an AR report is they look for something called receivables concentration, which it means when a great part of your receivables is held by 1, 2, or 3 companies, or even less, so 1 or 2 companies, it means that you, as a business, may be at the mercy of the financial health of the other business. Because if your client goes out of business, there goes 90% of your receivables, 80% of your receivables. So something important to keep in mind to make sure that you know the bank is going to look at that, right? If it's a reality, it's the reality. Now, for inventory valuation, one thing I'll tell you, one of the most important tips is write off inventory constantly, regularly. You would think that having a lot of inventory helps. It actually does not, because there's something called inventory turnover, which is the measure of how long it takes for you to get rid of your inventory. The banks look at that. They want to know that you sell good inventory. They want to make sure you don't have obsolete inventory, right? If you're a technology company and you have a lot of inventory and you show the bank a inventory valuation report, and you have a bunch of iPhone 4s, you have $100,000 worth of iPhone 4s, the bank says, you know what, this is worth nothing, right? Because nobody buys an iPhone 4 anymore, right? It's kind of the concept. So there's important concepts about that. So constantly write off your inventory. Okay, so for my last piece, I'd like to talk about my experiences in the bank. Okay, I wrote an article for Intuit a couple months ago. I'm going to pull it up real quick. I don't have the link, but if you actually Google Hector Garcia banker or something like that, it will show up. So I'm going to put Hector Garcia banker. I think it's the first one that will show up, or Hector Garcia banker Intuit. And you're going to see an article. There it is. Insider advice from a banker. I'm not much of an insider anymore, but so basically I wrote this article where I basically put together everything that I learned in the bank about why is it so difficult to get loans approved. I used to be a lender. I used to be a small business lender. My job was to put together deals, try to get them approved for small businesses. So I went through the process of understanding every little thing that the bank looks for: solvency, liquidity, equity. So I recommend you look into that article. It's actually it's very dear to me. It did take me some time to write it. So based on some of the things I put in that article, my experiences is with the bank. The banker typically wants you to get the loan. The banker encourages you to apply for a loan. The banker will make money or makes commission. That's his job. The banker feels optimist, right? They go to your client and says, yeah, sure, you get the loan. But what's the problem? When it gets to the underwriter, that's your bottleneck. Underwriters need to document and make a judgment on why it made sense to write that loan, right? They have to document the risk level of the loan, right? The probabilities of losing on that loan or defaulting on that loan. If a lot of loans go bad, underwriters lose their job. So I call underwriters the pessimists and the bankers the optimists. So I want to take you through an exercise of just some examples of things that I went through when I was in the bank presenting financial statements for my clients for loans. And me as a banker, I was an optimist, right? So scenario number one, I have a client that had really fast growing sales, and they were asking for an expansion loan. So the business owner and the banker were excited, right, because we're expanding. What does the underwriter say? Well, they're growing too fast. They may lose control of quality. They may lose capacity to deliver. So what is interesting about when you look at financial statements and when you present them, I want you to keep in mind that what you see as a positive thing the underwriter has a way of twisting it to see it as a negative thing. So it is your job to coach your client and to understand, how to explain these gaps of perception, right? The great things about, expanding sales and the negative part of expanding sales. So the optimal that I've seen, the most of the loans that got approved in terms of sales growth is when the sales were slow and steady, right? So 5%, 10%. So 20, 30, 40% growth, it's a great thing, but it could also be seen as a risk. Gross profits are increasing. So as a banker, as a business owner, that would be great. These people have found a way to make more money per item. They're more efficient, right? They're more profitable per product. But the underwriter will come back and say, you know what? Maybe they're buying from a lower quality vendor. Maybe the reason they're saving money is because they're buying a cheaper product. Could this hurt their reputation? So what is the optimal thing? The optimal thing is that the margins are steady and predictable. Banks like predictability. And also, you want to explain increase in margins, not due to buying cheaper products, selling low quality product. You want to say, look, we have a revenue mix that involves more high margin products and more services, which are 100% margin. So you want to discuss these things with your client to make sure they know how to explain them to the underwriter or to the banker when they apply for a loan. Another typical one is payroll. Payroll expenses are decreasing. So glass half full. We are cutting costs. We're more efficient. What does the underwriter come back and say? Well, maybe they have less capacity to serve their clients. Are they firing their high-skilled employees and hiring low-skilled employees? Can the business owner maybe can't even afford to pay themselves anymore. So that's the glass half-empty view of decreasing payroll expenses. So what is the optimal things I observe? I observe a steady workforce, low turnover. Something that my underwriter used to look at, and it was kind of a strange thing. My underwriter was very specific. They said, can you ask the business owner what is the average employment age of their employees? And they used to compare if the average employment age was close to the length of the business, because in her experience, a business that has all the original employees or 90% of the original employees is more likely to succeed than one that is turning and churning employees all the time. They're interesting ways to look at this glass half empty, glass half full thing. Now, what about the other side of the coin? Payroll expenses are increasing. So a business owner, a banker, an optimist would say, that's great, we're expanding our workforce. So what would the underwriter say is, well, maybe you're losing operating efficiency. It requires more people to do the same amount of work. Do you have enough managers to maintain high quality? Or is the business owner doing less work and putting themselves out of payroll? Or is the business owner paying themselves too much payroll? So what are some of the optimal things that you want to keep in mind is what they want to see is they want to see a percentage of increase in staff to be with the same growth rate as the sales. And you also want to show that key employees are getting raises and promotions. Key employees, the ones that make the business work. So those are some good ways to mitigate these type of questions, these type of things. Now, increasing shareholder distributions. So so a business owner would say, this is great. Now my business can afford to reward me. And then underwriter would say, they're bleeding the company out of capital, right? And they want the bank to finance their lifestyle. So the optimal thing is to have a strong capital retention policy. Capital retention means not distributing your capital is tightly associated in the financial world with growth. Let's see. Receivables increasing. So normally we would say, that's great, we're growing our sales. And this is where underwriter would say, are the receivables old? Is there a high concentration? Inventory increasing, great. We're prepared for the busy season. We have immediate inventory. Underwriter would say things like, hey, if the inventory loses value, is there obsolescence? So these are some of the important thing is you have to know how the banks think before you put the loan together and sit down with your client and discuss all these possible positive or negative things. And the last thing I'll show you is one of the things that stuck by me. I remember this. We memorized these. A bank used to call it the 5 C's of credit. So the bank says we narrow down all credit decisions to the 5 C's. It's capacity. Can the borrower repay the loan? This is where financial statements come into play, right? Do they have profits? Do they have net income? Capital. Is the borrower invested? Are they putting a down payment? Are they putting capital in the business, or are they distributing it all? That's an important piece. Collateral, are there fixed assets? Are there receivables, good ones? Is there inventory, good ones? Is there collateral that the bank can say, you know what? If the business can't pay, I have something to go after. Conditions, right? Is the industry in good shape? Are there external factors, regulatory factors, environmental factors? So this is where the industry, some banks don't like certain industries. And character. Character is the credit history of the owner, credit history of the business. This is statistical risk. Based on their credit score, they figure out the risk level, and that's how they price their loans. Most banks, the reality is that most banks could approve most loans. The problem is that a lot of banks don't want to charge 15, 20, 30% for loans because they don't want that reputation. So because banks, traditional banks, are in the business of low-rate loans, they typically don't want to write to high risk. Okay, I'm finished. Michelle, you can take over.
Okay, Hector, one thing I might add on that too is number 5 on character. I think a lot of us forget, or a lot of our clients forget, how important that is because the small business owner is the bank, basically. And so the small business owner, is the borrower. The owner of the company and the small business are one and the same. So the credit rating and their financial position is just as important as the business. So the banks are going to look at the owner's financial position and their net worth and their debt. And so they have to clean up their own financial house, their personal, as well as the company. And that's one thing I think a lot of small businesses forget about is if I'm going to get a loan, they're going to look at my financials too, not just the business.
Right. So the business owner has complete control and access to the capital of the business, right? People think it's ridiculous that the bank looks into the owner's credit, but it's not. The owner has 100% control over the capital.
Yeah. So, Hector, this was great information. Everybody was really loving it. There were some people in there asking if you could post the link to that article that you mentioned. So if you could put that in there. And then there was a couple of other little questions there towards the end. Those of you that are listening, CPE keyword is coconut. Please, if you're doing something else, write down coconut. Are you having a drink with coconut in it to celebrate the end of tax season? Coconut, 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 coconut. So write down that CPE keyword, and we will give you a poll question with the word coconut as the answer that you hopefully will provide us a little bit later. So one more time, coconut. I hope you got that. Okay, my turn now, and I'm going to go ahead and talk just briefly. Hector already went into QB Desktop to show you a few things about reporting. I wanted to go into QBO and show you a few things about reporting. One thing I did want to mention, don't forget that in QuickBooks Desktop, you can use Statement Writer. Statement Writer allows you to go in and format those reports and get additional information. Like somebody was asking about, I want last year the full year, and I want this year year to date. And those are some things that you can do in Statement Writer in the desktop version. Now, in QuickBooks Online, there's some things that we can do that you can't do in the QuickBooks Desktop version. For example, you can go in and create groups of reports that the bank wants to see. You can set it up to automatically email those to the bank every single month. So you don't have to remember to do that. Also, there's something new now called the management reports that really look nice and pretty. So I want to go in and show you this just briefly to make you aware of some of that. So I am in the QBO sample company. Let's say I've got in here and customized things, and somebody asked, like, for example, one of the questions I saw is, can you do multi-year reports? And yes, Hector showed you how you could do like a monthly financial, you could do quarterly financials. Let's say I wanted to do, a 3-year or 5-year balance sheet. Let's say I wanted to go in here and do 3/31/ let's just do 2012 through 2015. Now, this is going to be 3 years, but I need to come in here and change my columns to do years. So under Customize, so I change my dates, and then I also change my columns. Instead of being monthly, I want to see years. So you change your dates and then change your columns to be years. So you could do a 3-year balance sheet in this example. Once you go in and customize a report, remember you want to save your customizations. And so I'm going to save this balance sheet, let's do 3-year, and put it in a group. So whichever reports that you want to put together, I've already created a group called Monthly Reports for the Bank. So you create the report. You save those customizations. Then you go into Reports and My Custom Reports. Here you'll see that group. I should refresh it if I want to see the new one that I just did. And this is where you'll want to set the schedule up for you. And we've covered this in depth in some of our other QB Power Hours where we talked about reporting. But this is where you can automate it to have those emailed to the bank every month. So here's monthly reports. I've got this group. You can see I can, oops, I'm sorry, I got into the wrong thing there. I was under My Custom Reports. Under the My Custom Reports, I can set that up to be emailed every single month. You click on Edit, and you go in there and you set the schedule of when you want those to be emailed. So in this example, I could send the balance sheet, the P&L, and statement of cash flows to the bank. Now, if you want pretty reports, we have this new tab here that just came out, I don't know, it's been a couple months now. I can't remember if it's December or January, but anyway, the management reports. This allows us to make pretty financial reports. So for example, what I did is I took the company overview that Intuit provided in here, and I changed it, modified it, and called it a monthly report. So let me show you how you can do some of this. Over here to the far right, let's click on Edit. Somebody's saying, why didn't the 3-year balance sheet show up? I need to refresh that, and I don't even remember if I actually clicked Save on it, Dina. I think I just escaped out of there and went to the next screen. So that was my mistake, not the QuickBooks mistake. So here's the new management reports. These look nice. Notice how I can come in here and I can have my pretty cover sheet. I could upload my logo. I can change the title. Instead of management report, we might do financials for bank, and you can put the bank's name in there if you wanted. Prepared by, who prepared them, or it could be internal, and you could say for management purposes only. So we may want to change this and put monthly financials. Because even if you're not providing these to an outside third party, these are nice, pretty reports for your clients too. Your table of contents, then we get into some preliminary pages. This is where if you were an accountant and have to provide a compilation report, you could put that information right in here. Or if you're a bookkeeper and you just want to put, this is for management purposes only or internal use only or whatever you want to put here, this is kind of a preliminary page. Then you get into where we can actually customize and add these additional reports. So for example, the first one here, profit and loss, the P&L and the balance sheet were already there. When I took the company overview, those were already there. But if I click on that, notice how I can go ahead and make this, compare it to the previous year. So I could say I want to do a comparative P&L. Maybe on my balance sheet, I want to compare it to the previous period. Maybe I want to look at this month versus last month instead of last year. I added a statement of cash flows to this report. I added a receivables and a payable aging. Maybe you want to see the aging summaries or the details, so you can add new reports to this. So let's say we wanted to add the statement of cash flows, the agings for both receivables and payables. Now maybe we want to add some stuff for management. If you click Add a New Report, let's say I want to show them sales by customer, because maybe this is for management only. Let's show them sales by customer summary or detail. I could go in here and do the period that I wanted to see. I can add another report. Maybe I want to add a collections report that I want to send to my owner every single month. I want them to stay on top of their collections. The collection report would give them the phone number and the contact information and all that. Maybe you don't want to put that in a monthly report. Maybe you want to set that up to be emailed to the owner of the company every single week. Maybe you want to send these reports every week. Maybe you wanted to also show them on here their expenses by vendor. Maybe you want to show them the expenses that they have by vendor. Maybe you also want to show them unbilled expenses so they can stay on top of the unbilled charges that they might have. You can go through here and customize this report and add additional reports to it. And then the last one here, you can have some end notes. So for example, I could include the expanded profit and loss, and I click on this little box right up here to include the breakdown of the sub-accounts. So this can be some of my end notes. Let's go ahead and look at what this would look like. Under the print or preview down here, I'm going to go ahead and show you what a nice, pretty, very professional looking report this will give you. So you can see here's my monthly financials, here's the table of contents. You don't really do anything with this. It will populate based on the reports that you add. And notice some of these reports that are more than one page, it does the paging for you automatically. You don't have to mess with that at all. As we scroll down, here's where you could put your preliminary, the information that you wanted to put there, your profit and loss. Look how nice and pretty that looks. So much prettier than just a standard report. Much more professional, and it really helps differentiate you from other pro advisors out there. So it looks nice. There's that statement of cash flows. We had our AR aging summary. Here's the AR AP, accounts payable. We got aging details so they could review that, your sales by customer. Let's go on down and look at that last one there where I did that. There's expenses by vendor, and then that last one that we did with the expanded profit and loss. Because the initial P&L, and then notice I got a little extra thing in there, the initial P&L was rolled up, so it didn't show sub-accounts. When I checked that little box, it allowed me to show the sub-accounts as well. So instead of being collapsed, this is expanding that P&L for us. So this is, then we could go ahead and print this. We could send it off. Once you get all this, let's go ahead and save it. This is a great way, again, for you to add value for your clients. Once you've got it out here, over to the far right, I could go ahead and send this. I could export it as a PDF. I could send it as a Word doc if I wanted to. Generally, though, I would want to send it as a PDF, so it locks those numbers in as of the date that I do this. So this is a new feature that's available in QuickBooks Online, and again, it's a great way for you to really start adding some value for your clients, whether they're sending the reports out to the bank or whether they're using them internally. So yes, we got some people that say, wow, those are impressive. You're right, Meredith, they are great, but just like with anything Intuit does, I love it when they give us these new features, but I always want more. For example, I can't memorize these management reports to automatically send them every week or every month, so I wish it could do that. Please send your feedback in as you work with these reports and you see, I wish I could do this, I wish I could do that. Send your feedback to Intuit because you're right. They listen to us and they keep making it better and better all the time. And I really love this new feature, and it's in QBO. This feature is not available on desktop right now. Okay? So with that said, yes, go ahead, Hector.
Yeah, no, you said it right there at the end. It's only QuickBooks Desktop. I have like 20 people asking, how can I do this with desktop? It's just not possible. We're going to jump into for Meredith now, right?
Yes. Let's go ahead and go to Meredith. And I will answer more questions as Meredith's talking in the chat room or the question box. Meredith, I'm going to go ahead and pass it to you now. So we're going to be seeing Meredith. Meredith Wood from Fundera is going to tell us a little bit more about getting capital that your clients might need. Hector, anything else before we let Meredith take it? Meredith, are you there?
I'm there. Can you see my screen okay?
I can see your screen. Take it away.
Awesome. Thank you, guys. As Michelle and Hector said, I'm Meredith Wood. I'm editor-in-chief at Fundera. We are a marketplace for business loans. And I do apologize. I have a bit of a cold, so if my voice goes out on me, just prepare yourself for that. But just wanted to jump right in. Hector did a really good job of explaining what bankers are looking for in the process if you have clients that are working with them to find a loan. But I think they've been approaching this subject of acting as a consultant, this advisor to your clients throughout the process. And I sort of wanted to smash one myth before we get started, which acting in this advisory capacity, you think, okay, I want to identify moments that I think my clients need capital, usually a cash crunch. They're waiting for someone to pay them, et cetera, et cetera. But remember, and we all know this, it takes money to make money. So instead of just waiting and trying to identify when those crunches are coming, try to identify clients that you think have growth potential and it's capital that would help them get there. And great examples of that, for example, if you have clients you know that really should be expanding and can expand, If you have clients that are in manufacturing and you know by getting a new piece of equipment or upgrading their equipment, they could output material faster and sell more. If they're in an inventory business, they've got so much demand. If they could take out a little bit of financing to put more inventory on the shelves, they could push it off. And so that is the mentality that I think it's important to start working with, is looking for financing for growth opportunities and not just to bridge those gaps. So jumping right in, if you have a client that you think is bankable that can get a loan from a bank, they should absolutely go that route. It's going to be the cheapest source of financing out there. But unfortunately, right now, small businesses are really struggling to get the capital they need from banks. And right now, I think that the statistic is about 85% of small business loan applications are denied by the big banks. And looking at it kind of in a different perspective, with 27 million small businesses in the U.S., there are currently 17 million that need working capital. That is a huge number and shows a huge need and an opportunity for you guys in particular. 5 million aren't even going about it because they're scared to do so. They don't want to waste the time and be denied. 12 million are, and then only 3 million are getting funding from the banks. So there's obviously a huge need to open up more access to capital for these small business owners. So Hector did a really good job touching on this, and back to the article he was referencing, I have a link for it here. He does an excellent job explaining how, just generally speaking, it's very difficult to get a loan from a bank, but even more so post-recession, I think it's important to know that bank lending to small businesses is just continuing to decline. It's not coming back, and part of that is government restrictions that are because of the recession. They have been asked to eliminate more risk from their portfolios, and small businesses are just inherently riskier than large businesses. And also, small businesses, when they need working capital, they usually just need small amounts. We're talking $40,000, $50,000, but it is not profitable for banks to underwrite those smaller loans because it costs them just as much to underwrite a small loan as it does a large loan. So in efforts to be more profitable, they've been turning their attention towards those larger loans. But as we all know, when there is a need that society identifies, technology likes to swoop in and try to help solve it. And that's exactly what is happening in small business lending right now. Alternative non-bank, or what you probably know as online lending, is booming. It's an industry that's growing tremendously year over year, and it's due in part to the approval rates are much, much higher than you will find at a bank. There's other pros associated with online lending. There can be incredibly fast times of funding. We're talking days. With certain lenders, the applications are shorter, which is good for time-sensitive business owners. There's also a diversity of product, which is nice considering every business owner has unique needs, and instead of getting thrown just into a term loan, they might have something that's better suited for them. And lastly, there are finally options for those with bad credit. Before now, if you had bad credit, you kind of didn't have an option there. And finally, there are lenders that are willing to put more emphasis on other parts of the application than just the credit score. But obviously, what's the catch? One of them you're probably very well aware of, and that is that the fees are much higher with online lending. And in some cases, they're higher than the banks, and many times they can be tremendously higher than the banks. So if you do have a client that's going this route, I would make sure that you prepare to help them understand just what the APR is and what that means. But another reason that alternative lending is a little bit scary that people often don't talk about is that because it's so new, it's very difficult to know where to go, which lender is going to give you the best customer experience and is going to give you the lowest rate. It can be very intimidating as a business owner. But that problem right there is exactly what Fundera is trying to solve. So with our marketplace, you're able to take a singular application and you can apply to dozens of lenders. So not only is there time savings, which is incredibly valuable to business owners, but you're able to compare your offers from all these lenders in one place, so you know that you're getting the lowest cost loan out there available to you. And even more so, our marketplace has a competitive nature to it, so we know that lenders are putting forward their best rate with us, more so than you would necessarily get going directly. So we are able to offer our borrowers a lowest rate guarantee. And so you can see we have dozens of lenders on our platform, and because we do have so many different lenders, we offer a lot of different products as well. And to be fair, we're kind of an umbrella of the online industry. And so this right here are also all the products you would find anywhere online. I could talk about these for days, but we are shorter on time, and if anyone has specific questions about a specific product, I'm happy to speak further to that at the end. But I do want you to take note how there's opportunity to collateralize with equipment, with invoices, and in particular how SBA loans are now available online, which is really, really exciting. Before I dive deeper into a few of these products, I did want to talk about what is important in an online loan application. They are, in many cases, very similar to the things that Hector walked through. Most online loan applications will not be as intense as a bank application. The closest will be an SBA loan application. But I would just keep in mind that the lower the cost of the loan and the longer the term of the loan, the more paperwork that's going to be involved. So if you have a client that comes to you and says, oh, I applied for a loan and I only needed 3 months bank statements, be prepared that they're probably going to get an offer back that has an incredibly high APR. So just sort of keep that in mind. But do know if your client asks you, what do you think are my chances of getting approved, which is such a scary question to be asked because you can really never answer that confidently. But let them walk through these 6 things. What is their personal credit score, which Michelle touched on? What is their revenue? And a revenue is really going to define the loan amount because you're not going to really get more than about 10 to 15% of your annual revenue. What is your profitability? For some lenders, it's going to be very important you're profitable. Even if you're doing millions in a year in sales, if you're not profitable, that'll be a little bit suspicious to some lenders. Others are going to want to know if you currently have another loan out with another lender because some aren't going to want to take second position to another lender because if you go bankrupt, obviously that first lender is going to be reconciled first before it even makes its way to the second lender. But if you currently do have debt and you're almost paid down on it, that's a different situation. Next is cash flow, which Hector touched on a lot. I think that bank statements is the one thing that unanimously any lender is going to ask for. They want to know how good you are at managing cash, how much cash you keep on hand. And so that is a very, very important thing to work with your clients on. And lastly, when I say past history, I mean when they pull your credit report, they're not just looking at a score, but they're going to try to identify things like bankruptcies, collection proceedings, foreclosures, et cetera, and then they're going to have specific views on each of those things. They may want you to be a year out from bankruptcy. They may want you to be 4 years out. It just depends on the lender, but those are all things that it's good to know before going in. So I want to jump in and spotlight just 2 of the products on our platform. The first, I wanted to pull this out because we find that when we are referred people by an accountant, they tend to be of a certain caliber. They tend to be stronger financially. Obviously, not only can they afford an accountant, they've been working with an accountant. And so we've found that 98% of the time, people that are referred by accountants pre-qualify for an SBA 7A loan. And this is by far the lowest cost loan you're going to find online. You see it still has 5 to 8% interest. It's usually paid over 10 years with monthly payments. And this is important to note. It is very much a bank loan in its nature. The only difference is that a portion of it is guaranteed by the SBA in the event that the borrower defaults, which helps banks lend to what would be appeared as a riskier borrower. And I also wanted to note, because I know it's a hot topic in the accounting industry right now, that SBA loans are only one of 2 products that we found online that can be used for business acquisition. So if that's something that you're considering in the near future, an SBA loan would be a really good fit for you. We also have a medium-term loan product through a lender called DealStruct that does the same thing. Over here, you can kind of see a snapshot of minimum requirements that it takes to get an SBA loan. Credit score is going to be pretty important here. You've got to be kind of far away from bankruptcy. And then I think most important to note is they're not going to take second position to any other lender. So I wanted to touch on one more product, and the reason being that,
Meredith, before you do that product, a couple of things, because some people you lose a lot of dollars with other things and stuff like that. Can you jump into the advisor program? Because I was more excited about that one.
Yeah, absolutely.
And then while you talk about the advisor program, I'm going to put the polling question, and I'm going to go ahead and put the polling question now. And,
awesome.
And I'm going to ask you a question. One of the questions that people are asking, a lot of people are asking, is how many times, so they see that you have 100 lenders, 50 lenders or whatever. how many times will you pull the credit if it doesn't work out with one lender and it goes to another lender? Because that seems to be a hot issue, is when you go
Yes.
for loans, how many times they pull credit.
Awesome. So do you want me to talk about the advisor program first before I jump into that question?
Yep.
Okay. So this whole time we've been talking about kind of putting yourself in a position to act in more of an advisory position with your clients, and we want to give you an easy way to do that, and that's why we built the Fundera Advisor Program. And what it is essentially you sign up at our site, free, www.fundera.com/advisor, and we give you two options. One option is that it's simply a referral link that you can send to your clients and it's sort of hands-off throughout the process. And then the other part of it is we allow you to create applications on your client's behalf. So you can totally control the process, prepare all the documents, and the client will only need to come in at the very end to obviously authorize the submission as well as authorizing that their credit will be pulled. So this is important for you because, one, you're solving a need that is incredibly pressing for small businesses. You're obviously increasing the service offerings to your practice, and you also have a revenue increase opportunity here. One is through adding more billable hours for helping them through this, or even just offering it as a package service for a flat fee. But we do also offer a commission structure. So if you send a client to us, they are successfully funded, you will receive 1% of the loan amount. So that's a $100,000 loan, that's $1,000 right there. But if you don't want to take a commission or you can't take commission, what we can do is take that referral bonus and push it towards your client's loan payments. So if they get that $100,000 loan and you don't want to pay the fee, we can in fact apply that to their first few loan payments. And lastly,
Meredith, that's a really big deal, Meredith, because some of us, we would have to disclose if we're getting paid for something we're recommending. And a lot of us don't want to lose our ability to we think that recommending something that we get paid on may lose our credibility. So I think it's really cool that we can take what essentially would be our commission for the referral and send it to the client. I think that's huge.
Just another way to delight them, I like to think about it. And so that's our advisor program. Michelle, sorry?
Yeah, and some people wanted to know, too, is Fundera available in Canada, and what about the advisor program for our Canadian pro-advisors?
So we are not available in Canada, and we will be as soon as because we're not a direct lender, it's about identifying lenders in Canada that we can bring onto the platform. So that is a future goal. For Canadian pro-advisors, you're welcome to sign up if you just want to get involved and be aware, and also if you find yourself maybe perhaps chatting with anybody who's based in the U.S., and you can give them obviously your referral link if that's of interest. But right now, we can't service Canadian-based businesses.
And we did have another question too. You talked about how when they apply, it goes to all these other online. It applies to all these online. Somebody asked, how many credit reports does it pull when they do that?
Absolutely. So this is probably the most popular question we get. And I just kind of want to preface something before I say this. So when somebody is submitting multiple applications to multiple lenders, they never do it. It never goes out there without their permission. They're completely in the know about what's happening, nor do we simply just push them off to these lenders. They stay with us the whole time. They do not talk to a lender until it's closing. So you don't have to worry about your client getting 20 calls from different lenders trying to sell them on their product. We essentially protect them during the process, serve as their sort of unbiased third-party consultant, which is also a role hopefully you will play. But in terms of credit reports, so if they decide to apply to multiple lenders, they will have their credit pulled multiple times. But here's how that works. The first time you have your credit pulled, your credit score will take a little bit of a hit. But what happens is the credit bureaus identify when you're rate shopping. So this happens when you do it for a car. This happens when you do it for a mortgage. This happens when you do it for student loans. If you have your credit pulled by the same type of lender in about a 2-week period, the credit bureaus can identify that you're rate shopping, and so it's essentially the equivalent of having your credit pulled once. So something you wouldn't want to do is come to our thing and say, oh, I just want to apply for one loan right now, and then come back to us in 2 months and say, oh, I want to apply for another. You do want to sort of keep it consistent and within about a 21-day period so that the credit bureaus can make that association that you are rate shopping.
Fabulous. So Meredith, some people asked if they could have access to your slides as well. Would you be willing to provide those so we can make those available to people as well?
Absolutely. I'll send those right over as soon as we're done.
And Meredith,
Very
something
good.
else. So some of us are getting started into this world of recommending people to loans and stuff like that. Does Fundera have people that we can email and say, hey, can I just run a scenario by you before I put an application, kind of tell you what's going on? You know, are you a person that can be reached for those sort of things?
Absolutely. So I just moved the slide over, you guys. This is my email. You can reach me directly. I'm pretty responsive on email unless I'm, on a webinar or something, as well as some social links. So I would be your point of contact there. I love that. I find that accountants prefer that, to sort of talk to someone and talk about the client's position and get an idea of probably what the best option is. And so I love doing that, and I would hope you would call me and feel that you can use me as a resource. And you send me an email, or when you sign up for our advisor program, I usually give people a call. And so you'll also have my cell phone number if you need to reach me at any time with any sort of question.
And I think you missed this part, Meredith. The advisor program doesn't cost anything. You just sign up and you have access to the information. I heard you were telling me that you're building some tools for education so the accountants can have access to these guidelines so they can educate their customers on loans. What other, signing up for an advisor is free. Fundera.com/advisor. Go ahead and do it even if you're not recommending a loan tomorrow. So you're in the system. What are other benefits of signing up for this free program?
And I just wanted to note before I go in there, Fundera is also free to the borrowers, so you don't have to worry about sending your clients this way and they have to pay something. It's also free for them. So the benefits are, by signing up, one, you have to get the referral link. You also get access to your portal that allows you to apply for on your client's behalf. We also provide you marketing materials. So you've got PDFs you can send to your clients, whether you want to directly talk, like you just want to tell them about Fundera, or if you want to we even have unbranded PDFs if you want to just add it completely to, as if you're adding loan packaging services to your business. So a lot of different marketing options, email templates that you're able to customize and send them to your clients to alert them of the new service. And within the portal, for any applications that your clients do start, it also gives you access to them. So they're like, oh, I need you to jump in and upload my tax returns. It makes it very easy for you to do that. And then it puts you on the list for future announcements. As Hector said, we want to make sure we're giving you guys the resources to feel like you can speak confidently about this industry, the pros, the cons, the application. And so we are building out webinars, certification courses that will allow you to have access to the educational opportunities that you can really walk away from and be like, I feel like I'm an expert in this industry now. And so that's why we're hoping to get people in now and hear about your feedback and things you want to see in there, because we're consistently adding to the program.
And Meredith, we're top of the hour, but go ahead. Go ahead.
No, go ahead.
One thing I was just going to say. Michelle, you go.
Okay, Meredith, this has been fabulous. A lot of the people are typing in the comment box how this is great. Some of their clients can't get traditional loans. The information that Hector covered was awesome. This is definitely an area where the bookkeepers and the accounting professionals can provide additional value to their clients. And I think the program that you all have, the advisor program, is a great opportunity for a lot of us, a lot of people, to expand your practice and grow beyond just the monthly bookkeeping or payroll or things like that. So I think this has been fabulous, and the feedback is very good in there as well. Hector, what were you going to say? Hector, what were you going to say?
That we've only lost. Yeah, I would say we've only lost 10% of the people. So we're on top of the hour, and it feels like some people are still interested. So Meredith, I cut you off on that second loan option that you were going to say, the short-term loan. So go ahead and cover that before we end it, if you don't mind.
Absolutely. So the reason I wanted to touch on this loan is because I literally think it's the loan product that defines this industry. It's completely unique to it, and it is our most popular product on the platform. And the reason is because this is like a little beginner baby loan, is the way I like to think about it. Like for those that are just trying to build credit history and get out there, and they don't really stand a chance of getting a bank loan, but they want to start somewhere. This is where short-term loans have been really great because they're repaid within 18 months max. We find our most popular term is 12 months. We have some that are short as 3. The interest rates are higher, but if you think about the fact that the debt is moving off their books very quickly, for some people it is the right option. And what's most unique about it is that you pay with daily payments, ACH from your business bank account. And it's only on business days, I should say. But for those that I was talking about that struggle with their credit score, you can see right here it's 500 up, or younger businesses, or maybe just recovering from bankruptcy. This is an option for them, and much better than the MCAs you hear a lot about. And so that's the thing that's good to know about the industry. If you've got clients that are really trying to build their credit, they need the capital. We have options out there that aren't traditional, and we will be honest when we consult with them about whether we think it's even a good idea to take on, a higher price loan. For some people it makes sense, for others it doesn't, and that's why we love being involved with the accountants, because we can have those conversations together. But like I said, many of our accountant referrals actually qualify for those single-digit interest rate loans. So we have not yet put an accountant client on short-term loans, but you never know what the future holds. So yeah, did you want me to touch on anything else? Hector?
Meredith, one more quick question. If they join the advisor program, is there a link that they can include on their website?
Correct. So you'll have your own unique link that you can use to send clients to, and we'll be able to track that they were referred from you.
Very good. There's been lots of great feedback, Meredith, so thank you. I know a lot of people have loved this. Meredith will send us her slides, and we will include a link to download those. You all get a follow-up email after the QB Power Hour, and we will include a link for that. And Meredith had her contact information on there as well, so that you can follow up with additional questions and things like that. I think this has been fabulous. Anybody else have some additional questions? I know we are over time, and appreciate all the people that have stayed on with us as we've gone a little bit over time here. Other questions,
Michelle,
comments?
How about the last? So I told I've been telling people that the people are asking about minimum credit score and things like that. Go ahead and email Meredith. Definitely have her help you with that or connect you with the right person. It takes a while for you to get deep into this subject. You have to go through a couple of applications first. I have the privilege that I was in banking, and I have this experience. But if you were not under these circumstances, you kind of have to go through a couple of loans to kind of just really understand exactly how the process works. And the last thing I wanted to cover, Michelle, I don't know if you were going to cover it. I want to talk about the upcoming webinar that we have in 2 weeks that I'm extremely excited about. Michelle, you want to talk about it?
Sure, yeah. Make sure you guys join us next Power Hour and help promote it as well. Let everybody know how much you enjoy QB Power Hour on Facebook and Twitter and things like that. Next one is going to be amazing. Hector and I are going to talk about the road to consultancy, getting away from just doing the compliance of services that we do every day. We're going to have special guest Ron Baker talking about hourly versus value pricing, and we also have Joe Woodard coming on to talk about education with a purpose. So this is going to be a great one that you definitely want to attend. So again, help Hector and I spread the word, and we can't wait to have you join us for that one as well.
Perfect. All right. Well, thank you, everybody. Congratulations on surviving tax season. Join us in the Facebook group. Join us in the LinkedIn group. We're going to send you an email with the recording of the webinar, the link to the advisor program. I strongly recommend that you look into that. It's free. Get yourself set up. It will give you access to the information that you need. Email Meredith, cases and stuff like that. This is an interesting part of consultancy. It's getting really deep into helping your clients grow by helping them get capital. Michelle, I don't have anything else to say. Otherwise, thank you very much.
All right. Thank you also, Meredith from Fundera, for joining us. We're very glad to have you with us today. Thank you guys all for joining us. We'll see you next time. Bye, everybody.